Okay, I'm starting with the long-term chart of the Nifty. This shows the entire time frame from 1999 to date. The one difference between Sensex and Nifty is that Sensex made a new low in 2001, and so the wave count actually starts from there. But on the Nifty, you can mark it a little differently, taking this as wave 1 and wave 2. Which is true in many cases, especially in the case of stocks which were not in the tech sector, essentially the likes of Reliance Industries, ACC, uh, well, I wouldn't say Tata Power, but yeah, those are two that come top of the mind, uh, which actually showed impulsive wave 1 and wave 2 structures. There are a couple of others that did so at that point of time, but there are many that did not, many that continued to make new lows, and where the bear market actually ended only in 2002. So there are variations and deviations in terms of how you market. But after you actually broke out of this zone, because I did think that this was a completed pattern, the entire structure here looks like triangular fourth, and whatever after that is fifth. So the only discussion is whether this is 1, 2, or 5, and is starting into a third. Most of the bull market theory builds around that. So I think this is a rare wave count in today's over optimistic environment to say that the fifth is ended, or it is forming an ending pattern like I've been showing on the mid caps, or that it's an expanded flat as I'm trying to express on this very chart. So I think this discussion would probably go on. But in my mind, the recent sell-off in the mid caps that we saw this month might end up being the most significant, because the serious outperformance of the mid caps, which is almost gone on for since 2014, so that's 3 years, is one of the longest in this entire period, because the earlier ones were a little shorter than that. And having done so, the recent moves also appear like the entire rally in 2016 and then 2017 this year, all of them appeared like 3 waves. So I'm actually able to mark ending patterns for the mid-cap indices. But for the rest, this chart will remain a debate, I think, because the Nifty is still going higher. We are at 9,600. During the last month, I was essentially thinking that we were in the process of losing strength because of some of the sentiment indicators that were significantly diverging from the market. Also, the breadth, the 20-day, 40-day advanced decline ratios were falling throughout this time frame, and so initially you got a reaction in the Nifty, but even as this stretched higher and those divergences continued, this reaction of course appears very small in Nifty, but in the broad market it ended up being significant, sufficient to actually push your weekly indicators to the sell side, which is why I think that this is a significant turn, at least in the broad market. So the only index which is actually not seen a cycle degree correction has been the Bank Nifty. What do I mean by a cycle degree correction? Is typically when you get a sell signal from a very high reading, it falls back to the zero line. So we saw that happen in Nifty in April. We've seen that happen in mid caps in this month, and so this week's weekly Elliott Wave update, which is already online, I've discussed that Bank Nifty is the only index which has not done that, and so I would think that that's probably the next most vulnerable point out of the other indices, because they have done it and they are trying to move higher, at least in Nifty. But Bank Nifty has still not done it. Weekly RSI is hit 78, which makes it relatively overbought, and I think we're ending into the RBI meet next week. Banking remains one of the focus areas, I think, for the market for the next 10 days. So I think this index is one where you should still be watchful in terms of an unexpected reversal, just like we saw in mid caps last month. So I think that would be my focus area. Now, in all this turmoil, I would like to bring up one particular segment of interest, and that is that relates to one of the discussions that I made, I think, more than a year back, and this is the long short report from last year, where I discussed this cycle. I was a little early on the cycle. This, of course, finds its roots in Martin Pinn's work, where these 3 cycles show you bonds, equities, and commodities. So they peak first, bonds bottom first, then equities, then commodities, and similarly they peak. You can find this trend always historically when you look at a long enough period of time. You can go back to 2008 and find bonds peaking early rates starting to rise in 2006-7, and then equities in 2007 and commodities in 2008. Of course, that was a year apart, and we are seeing a much larger cycle this time around. So bonds, in terms of the 10-year, peaked in 2013. In terms of the 30-year US bonds, they peaked in 2016, which is last year. We have still not got the final equity point, but which I thought was there, like I said, in 2015. But now the US indices are higher. It's still not reversed course. But when they do, and my expectation would be this, that similar to that period, you'll get this lag and commodities start moving higher again. And a lot of people disagreed with this view, but you got the bottom in commodities last year. You got a rally in zinc, aluminium, and all these base metals, including precious metals. And while they may all have paused, it's essentially, in my mind, a consolidation. You're seeing oil consolidate, say, between $52, $53 and $48, $45 on the downside. And it's very much possible now that the dollar has started its next leg down, breaking a lot of trend lines and key supports that all the bulls are watching. The consensus is slowly moving towards the bear argument for the dollar, which can cause a short-term pause or bounce, but I think the trend down is pretty much now established and should mean higher commodity prices. So we are somewhere at this, within this zone. You haven't had the rollover in equities, but I think commodities continue to rise for a prolonged period of time. And that's, I think, essentially been the view that I've been posting: falling dollar and positive commodities or positive precious metals, and you'll find that in a lot of my work. And so people are only focusing on the market, looking at sectors that were performing last year to buy, maybe to buy pharma, to buy IT. They've all ended up being on the wrong side, and which is why I'm saying this is not a, while the Nifty might be at a new high, not being a broad-based bull market essentially does not classify it as a serious bull market. So you saw my Elliott Wave markings; they are either an ending in mid-caps, or I discuss the potential of corrective patterns in the Nifty itself into the new highs, if not an ending and expanded flat, which can also allow you, up to 138% of wave A, and we are still well within those levels. That allows you up to 9,800. But the reason that I'm more cautious at each level from 92, in fact even 8,900, and then significantly up to 9,200, is because you're seeing the divergences in stocks very, very clearly. You're getting this run ups in stocks, and then they are peaking out, and the stocks are rolling over. And that's the part that people end up missing, is that in the final phase of the move, while you have go-off runs in certain stocks, moment they roll over, if you're not, or they may have completely reversed course and stop seeing highs. We saw that in PSU banks, we saw that in the Midcap index, several stocks cooling off. Will they bounce back and retest the highs? Some are doing so, some may not, and that remains the major risk when you're getting that rollover. But my sense looking at this is that if this part of the cycle plays out, then the only sector that would probably hold out would be commodity related. And if you go back and see in 2008, even up to June, when commodity prices were going up, Tisco, even though it sold off initially, it went and retested that high, making a double top only in June 2008, even with the Sensex or Nifty were much lower. You saw that also in Hindalco with aluminium prices and so on. So the commodity cycle does play an effect on equity prices, but of course that doesn't mean that if equities are falling at the same time, these stocks would probably be going up. While they are falling, then you also end up having a falling trend in the individual items. So the thing to watch with the mid-cap indices will essentially end up being as to whether this pattern sustains. We've sold off from the upper end of this trend line, very close to the 20-week average. What is interesting is on the daily chart, we came close to being oversold, and you've bounced back and essentially making a retracement of this fall. So how much will we retrace? Will we retest a high, make some kind of a triangular ending pattern, or simply do 38 to 50%, maybe touch the 20-day EMA and then sell off again? So that's what we'll be watching this week, whether the mid-cap behavior will be and should be, I think, very different from what the Nifty behavior might be. And like I said at the start, the Bank Nifty is the area that would carry a higher risk, because it's not had any correction, unlike the other two segments. So the center, from a global macro perspective, the central theme, I think, which you have to understand what it means for each asset class, is likely to be, at least for the time being, the falling dollar trend. And of course, you have a rally in US bonds, which is right now going on, but this is a counter trend move, and at some point of time, the bond market would sell off again. And I think any US bond market sell off would also be negative for the dollar itself. So those are two macro trends that would be in focus. And the dollar itself, the monthly momentum essentially crossed to a sell at last month itself. Another 3 days to this month's closing. We'll be watching whether it breaks the 20-month average, which would be another confirmation to the opinion that we are done here. And after that, we would expect it to probably go to around 93 in its next move. But then that's just one part of the move. So the sense is that it's a multi-year downtrend that is starting for the dollar, a complete reversal after a almost 9-year uptrend. And historically, you've had up to a 7-year bear markets in the dollar when you take a very long frame. This bear market in the 80s, this subsequent one in the 2000s, both of them were almost 7 years long, and the uptrend have been 8 to 9 years long. And so we've just had a 9-year bullish phase, which I think is ending, and you're entering a multi-year bearish phase for the dollar, and that's going to mean a lot of things for different asset classes and positioning in global macro trends. And I think that's going to be one of the factors you'll have to figure out to get your asset allocation right. So that's all. This is a short video. I think I've covered most markets and key ideas that I'm updating on a daily basis and what they mean for the markets. Thank you.